limited liability, which means if the business goes bust, you as a bank are getting nothing back, essentially. You know, that's it. So that's kind of high risk compared to loaning your money to somebody with some collateral, with a house behind them, like a mortgage. So there's a kind of simple incentive for banks to prefer putting money into housing than into a small business. Now that's a real problem, or if you widen that out across a whole economy, because it means there's an incentive, you know, to put money into speculative rather than productive investment. So again, we have to think about how we create a monetary system that is more balanced between those two kinds of speculative and productive investment. The government showing very little, enormous reluctance to regulate the housing market and to, again, regulate the amount of money that banks put into houses.
We don't decide who creates credit for what. No, we leave that to a couple of chaps in a bank to decide, basically.
A bubble occurs when there is very high inflation in the price of a specific good or service over a short period of time.
The idea of the tulips and their relevance is that we saw the first ever financial bubble and crash. The craze for tulips, black tulips being a mythical ideal of what somebody could genetically engineer through cultivation after many generations, became a mania in the Netherlands in the 1630s. What they didn't realize was that many of the very, very rare patterns on tulips were caused by a virus and weren't genetic at all. But they traded in them, to the extent that tulip bulbs got to the point where they were worth 10 times the average annual salary of a person working in the Netherlands. There was a futures market in tulip bulbs, because obviously you plant them now, but you don't know what's going to come out of the ground. So we see already, 400 years ago, that a money system or a financial system is not something that exists in the abstract, somewhere out there in the ether, but something that was to do with states, power, trade, and how they interact with each other.
Unlike tulips, which are a disposable luxury, houses are both a necessity and a luxury, and as such they are ideal as a vehicle for money and bubble creation. A dwelling is perhaps the most prized possession of value most people aspire to. Inflating house prices in this way allows a nation to expand its money supply without affecting inflation data. The additional purchasing power created increases the perceived wealth in relation to other nations, and thus it creates relative power. It is a way of increasing monetary power without investing in the productive growth of industry.
But certainly if you look at Britain and America as outstanding examples of this, these are countries with very high rates of private home ownership, so you've got a good base to try and perform this sort of policy off the back of. I think it was quite deliberate in the case of the US, almost explicit. It was Alan Greenspan, as head of the Federal Reserve, when confronted by a stock market crash at the end of the 1990s, quite deliberately slashed interest rates to almost zero. Everyone can borrow very, very cheaply. In particular, it's very easy to borrow against a house because this is an asset and it's potentially something that a bank can say, well, okay, we're not just lending you money unsecured, you actually do have a house, and that's great because we can repossess it. They won't tell you this when you take the mortgage, but they can do this. And that bubble is then what fuels expansion, such as it is inside the US and inside the UK, where something similar takes place for the next decade or so. I think it's also a reflection of an underlying weakness of these governments, that they simply lack the will and possibly the ability, but I think it more comes down to a will to challenge financial markets, to challenge big capital and say, we're going to do something different now, and you're going to have to go along with it, because we've been democratically elected and you lot frankly haven't, and we have a mandate to do this and we're going to make this happen.
Just remember, it's all part of the plan. What are you yapping about? You voted for it.
In Holland, or in the Netherlands, what we had over a period of trying to get independence initially from Spain and trying to raise money to get an army to free themselves was financial innovation. They innovated public lotteries to get money together. They had public subscription. This was the idea that led to the idea of public shares, a piece of the action that anybody could invest in. That meant that something like 2/3 of the population was investing in tulip bulbs by the 1630s. After independence, these instruments were applied to financing expansion. Why was such a small country able to hold its own against so much bigger countries, for example, Spain and Portugal, that had the benefits of their empires for over a century in respect of the Netherlands? Why could they compete? On what resource basis? Well, they had a more efficient, a more involved, and a broader-based financial system with these instruments that they'd innovated that allowed them to bring more money to bear at one point than anybody else more quickly.
Incredible, but true.
Now, inflation can be avoided if the amount of money that goes into the economy is regulated in a way that it doesn't exceed the actual activity that's happening in the economy. Now, the best way to do that, in my opinion, is to make sure that money is issued into the economy only for productive investment, for productive goods and services. So money goes in to help a small business start up, which creates jobs, which creates additional purchasing power, which means there's no inflation.
During their history, almost all central banks have employed forms of direct credit regulation. The central bank would determine desired nominal GDP growth, then calculate the necessary amount of credit creation to achieve this, and then allocate this credit creation both across the various banks and type of banks and across industrial sectors. Unproductive credit was suppressed. Thus, it was difficult or impossible to obtain bank credit for large-scale, purely speculative transactions, such as today's large-scale bank funding to hedge funds. The World Bank recognised in a 1993 study that this mechanism of intervention in credit allocation was at the core of the East Asian economic miracle.
There's all sorts of things that governments have done in the past, very successfully in a number of cases, and often not unsuccessfully in this country, but the examples that spring to mind, like South Korea, Japan, often in East Asia, where governments have been quite targeted about how they're going to rebalance the economy and picking sectors and deciding where the investment should take place. I think that has to start happening in the UK because we're in a demand-side recession rather than looking at a crisis of supply.
You have to have a system where credit is put into productive avenues, where credit is put into building high-speed rail links, where credit is put into building houses rather than giving people money to inflate the price of houses. So it's quite simple, really, in that way. The current system is simply set up not to do that, basically.
The creation of money by private banks for non-productive usage causes real inflation, and as such it is a tax on the purchasing power of the medium of exchange.
The figures for the UK are quite stark, actually, that average, median, real incomes so that's, what, a bit in the middle, for most people declined over the last 8 years or so. They're now in quite sharp decline as we go into the recession. I mean, the sharpest really since about the 1930s, put it that way. So real incomes are declining.
Bank-created fiat currency allows the private banks to suck wealth from the economy, and over time results in a gradual decrease in the standard of living. As people become poorer, they become even more dependent on debt. And this at a time when efficiency and machination have improved dramatically.
You go back to the 1960s, and we were expected we were looking forward to an age of leisure. They were talking in television programmes saying, what's people going to do with all their spare time? And now we've got more people working harder than ever, spending more than ever, which looks great. Everyone's spending more. Everyone says, oh yeah, But if you're not actually benefiting from what you're spending, if you're having to spend the money on childcare costs, on commuting costs, and so forth, just the costs that people didn't in the past used to have to pay, because you could walk to work, and one member of the family was able to stay at home and be a permanent homemaker, then you're not actually any better off. Everyone's under such enormous pressures nowadays. I am conscious that, say, my 4 nephews and nieces are facing difficult times. They're just going to find themselves having to work, very hard just to keep a roof over them, just to get a roof over their head, just to keep a roof over their head.
People are getting poorer in real terms. It's because prices are always going up, because all this new funny money is being pumped into the system by the banks, and they're creating it all as debt. So at the same time as prices are going up and things are getting more expensive, we're getting further and further into debt, and our wealth and the return that we get from actually working is getting less and less all the time. I mean, you can't deal with poverty when you have a financial system and a money system that distributes money from the poor to the very rich. Any distribution that you try and do in the opposite direction is, it's effectively pissing in the wind. If you look at issues like, increasing inequality, one obvious way to tackle inequality is to have, say, for example, a redistributive tax system. You tax the rich, you give some money to the poor, you move a bit of money down the scale. That's all very well, but if you completely overlook the fact that there's another redistributive system which is taking money from the poor and giving it to the rich, then you're not really going to tackle this inequality. And the way a debt-based money system works, it guarantees that for every pound of money, there's going to be a pound of debt. Now, that debt is typically going to end up with, the poor, the sort of lower middle classes. Those people end up with the debt, and they end up paying interest on that money, which then goes back to the banking sector and gets distributed to the people working in the city or in Wall Street. And what this system does overall is it distributes money from the poor to the rich, essentially. Distributes money from the poorer regions of the UK back to the City of London. And it also distributes money from all the small businesses, all the little factories around the UK, and distributes that money back into the financial sector.
We have a system whereby the activity of actually supplying our nation's money supply occurs under the very same roof as the same organisation that's responsible for profiting from putting together borrowers and lenders, i.e. a bank. So a bank creates our nation's money supply as well as making loans for profit.
The government cannot allow the banking system to fail, because if it did, over 97% of all money would disappear. This is why, in the event of a crisis, the risk is transferred to the taxpayer. But even during normal times, banks receive numerous guarantees and benefits beyond the right to create money.
Bill, by the way, I know the Bank of America is a very big bank. It happens I've got $32 there myself. Now, just between us, what assurance do I have that this money is safe?
Well, all deposits up to $10,000 are assured or insured by the federal government in Washington.
That's my guarantee. Huh?
Yes.
Have you heard that the federal government is about $280 billion in the hole?
Banks receive large safety nets from the government. The taxpayer guarantees £85,000 as deposit insurance, and the Bank of England provides liquidity insurance in case a bank runs out of reserve currency.
Someone wrote that a big investment bank is like a giant vampire squid wrapped around the face of humanity, hypnotizing politicians who throw money at the banks, no strings attached, no matter what damage is done, trashing the planet, forcing cuts to things that make life better. Goodbye schools, goodbye playgrounds, goodbye jobs. The bankers that we bailed out then gave themselves bonuses that were bigger than the first wave of public spending cuts. Britain alone gave the banks more money than it cost to put a man on the moon, 6 times over. Where did our money go? Who let the banks get away with it? Why? Can vampire squids ever be useful? No government yet is brave enough to tame them. Perhaps they need a plan.
The spending cuts agenda is an attempt by the government to shift debt from its account to that of the public. This is the government's response to the bank bailouts and is necessary in a debt-based monetary system where increased purchasing power is the result of growing debt and where a diversification of debt provides overall stability and market confidence. Policies such as student fee increases and the privatisation of public services, assets and industry follow the same model.
The problem we're facing, I think, is that there's this transference from the public debt to the private debt, which is essentially a way of transferring risk, actually, away from sort of UK PLC and the government onto the heads of individuals, and it's going to be the most vulnerable individuals who are going to have the most debt. Thus, it's a very unprogressive, regressive policy framework that the government's embarking on, where the risk is moved onto those who are most vulnerable. And if there is another financial shock, if there's an oil shock, for example, the people who will pay the penalty are the poorest people in society. Or homeowners, for example, who will fall into negative equity if interest rates go up even 1 or 2%, there'll be really big problems. So I don't think it's a sensible way forward at the moment at all, and it's regressive, and it's certainly not fair in the terms that the government's talking about, and it's certainly not a case of we're in this together.
As more of a country's resources and industries are privatised, the private sector takes on more debt. As a result, more money is created, and there is a boom. Some private equity companies have taken this theory to the extreme, engaging in a practice known as a leveraged buyout, where a company is purchased at an often inflated price, and the purchase price is transferred to the business as a debt. The company becomes responsible for the funding of its own purchase. These debts are often so great that the company needs to reduce staff, salaries, and research activities.
When you have to factor interest as a business, if you have to factor interest repayment into your goods and services, then you have to charge a perpetually higher price as you take on more and more debt.
An increase in the diversification of debt results in an increase in the money supply. When the money supply increases, more money is available for productive activities and consumption, which is the condition for a boom.
It's questionable whether we're going to get out of this recession or whether we'll just keep ticking along the way that we are now. However, if we do, then when we come out of this recession, when growth starts again, look at what happens to debt. It will rise, and it will keep rising, and the faster the economy is growing, the faster the debt will rise. And then give it another 3 to 5 years, we'll be back where we were. You know, the debt will become too much, people will start defaulting again. It's kind of the system that we're locked into now, is we can't grow the economy without growing the debt, and the debt is the very thing that will bring down the economy. The only option going forwards is to reform it, to stop banks from creating money as debt. By fixing the monetary system, we can prevent the banks from ever causing another financial crisis. And we can also make the current public service cuts and the tax rises and the increase in national debt unnecessary.
The current monetary system allows the banking sector to extract wealth from the economy, whilst providing nothing productive in return.
I mean, why is it that we've got all this technology, all this new efficiency, and yet it now requires 2 people to finance a household, whereas in the 50s it only needed 1 person working? And the reason for that is not because these washing machines and everything are more expensive, it's because of all the debt. And it's because effectively the banking sector is creaming it off from everybody else. So a growing banking sector isn't a sign, it's not a good thing. if the banking sector is growing, it's either that it's becoming less efficient or it's becoming a parasite on the rest of the economy. And that's, you know, we can talk about the banking sector becoming 4%, 5%, 6% of GDP. What's happening to the rest of the economy? It's becoming 96, 95, 94% of GDP. We've got to get switched on to this now. You know, if we want to have a chance of tackling any of the other big social issues, you've got to figure out the money issue.
The poorest in the world pay for crises, even when they've not benefited from the often reckless and speculative booms, like the housing boom in Ireland that preceded that crisis. You know, over the last 30 years we've seen income differentials increase so that the rich have got much, much richer. And ordinary people haven't. They've stayed the same or they've got poorer. And one of the ways that the economy was kept going